In this video, today we will talk about the story behind banks. The story behind banks is a fascinating journey through history, reflecting the evolution of economies, societies, and the need for financial systems to support growth and stability. From ancient times to the modern era, banks have played a crucial role in shaping civilizations and fostering economic development. 1. Ancient beginnings, temples and money lending. The origins of banking can be traced back to ancient civilizations, where temples and palaces served as the first banks. In Mesopotamia around 2000 BC, temples stored grain and other goods as deposits, and they began to issue loans to farmers and traders. The concept of interest, a fee charged for borrowing, also emerged during this period. In ancient Greece and Rome, moneylenders operated privately, providing loans to individuals and businesses. They would also exchange currencies for traders engaged in commerce. Temples and private moneylenders thus laid the groundwork for the development of more formal banking systems. 2. The birth of modern banking, medieval Italy. The modern concept of banking began to take shape in medieval Italy, particularly in the city-states of Florence, Venice, and Genoa. During the 12th and 13th centuries, merchants and moneylenders in these cities established institutions that accepted deposits, issued loans, and facilitated trade by providing letters of credit. The word bank itself comes from the Italian word banca, meaning bench, where moneylenders conducted their business in the market squares. The Medici family of Florence, one of the most prominent banking families in history, founded the Medici Bank in the 14th century. The Medici Bank became a powerful institution, financing trade, art, and the papacy, and it laid the foundations for modern banking practices. 3. The rise of central banking. The Bank of England. The late 17th century saw the emergence of central banks, which were established to manage a nation's currency, money supply, and interest rates. The Bank of England, founded in 1694, was one of the first central banks and remains one of the most influential. The Bank of England was created to raise funds for the government to wage war against France. It issued banknotes and managed public debt, becoming the model for central banking systems around the world. Over time, the Bank of England developed tools to manage inflation and ensure financial stability, functions that are central to modern central banks. 4. The expansion of banking. The Industrial Revolution. The Industrial Revolution in the 18th and 19th centuries transformed economies and societies, leading to an increased demand for banking services. Banks played a critical role in financing industrial enterprises, infrastructure projects, and international trade. During this period, joint stock banks emerged, allowing individuals to invest in banks by purchasing shares. This innovation expanded access to capital and facilitated the growth of large-scale businesses. In the United States, banks like J.P. Morgan & Co. and the First Bank of the United States were instrumental in financing the nation's expansion and industrialization. 5. The evolution of banking services. 20th century. The 20th century brought significant changes to banking, driven by technological advancements, regulatory developments, and globalization. Banks expanded their services beyond traditional deposit-taking and lending to include investment banking, wealth management, and insurance. The Great Depression of the 1930s led to increased regulation of the banking sector, particularly in the United States, where the Glass-Steagall Act separated commercial and investment banking activities. The establishment of deposit insurance and central bank oversight also aimed to prevent bank failures and protect depositors. The post-World War II era saw the rise of multinational banks and the expansion of global financial markets. Technological innovations, such as the introduction of ATMs, online banking, and electronic payment systems, revolutionized the way people interacted with banks. 6. The financial crisis of 2008, a turning point. The global financial crisis of 2008 was a major turning point in the history of banking. Triggered by the collapse of the U.S. housing market and the widespread failure of financial institutions, the crisis exposed significant weaknesses in the global banking system. The crisis led to a wave of bank failures, government bailouts, and a re-evaluation of banking practices and regulations. Central banks around the world, including the Federal Reserve and the European Central Bank, implemented unprecedented monetary policies to stabilize financial markets and restore economic growth. In the aftermath of the crisis, governments introduced stricter regulations, such as the Dodd-Frank Act in the United States, to enhance the stability and transparency of the banking sector. The crisis also accelerated the adoption of financial technologies, fintech, and the rise of digital banking. 7. The digital revolution, fintech, and the future of banking. The 21st century has seen the rise of fintech, which is transforming the banking industry. Fintech companies leverage technology to offer innovative financial services, such as peer-to-peer lending, mobile banking, and cryptocurrency exchanges. Traditional banks are increasingly adopting digital solutions to meet the demands of tech-savvy consumers and compete with fintech startups. Mobile banking apps, online loan applications, and blockchain technology are reshaping the way people manage their finances. The rise of cryptocurrencies, such as Bitcoin and Ethereum, represents another significant development in the evolution of banking. While traditional banks have been cautious in adopting cryptocurrencies, they are increasingly exploring blockchain technology for its potential to improve efficiency, security, and transparency in financial transactions. 8. Sustainability and social responsibility. In recent years, there has been a growing emphasis on sustainability and social responsibility in banking. Many banks are integrating environmental, social, and governance (ESG) criteria into their lending and investment decisions. This shift reflects a broader societal trend towards sustainability and the recognition that banks can play a crucial role in addressing global challenges, such as climate change and social inequality. Banks are also increasingly involved in green finance, which involves funding projects that have positive environmental impacts. The rise of sustainable banking reflects a changing business environment, where consumers and investors are demanding greater accountability and transparency from financial institutions. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.